Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Welcome back to the show, Rick.
Well, thanks for inviting me on, Jim. It's always a pleasure.
Rick, I recall over a year ago, the U.S. Fed said that this inflation we're seeing is transitory. It's just going to disappear into thin air. Don't worry about it. Well, here we are a year later with inflation that's running at its highest level in 30, 40 years. Why do you think the Fed is not doing its job getting a handle on this, if they could, and can they?
No, they can. I think that the illusion that the Fed is somehow in control is one of the epic hoaxes of our era. The inflation isn't really hard to figure. It's a couple things that came together in a perfect storm. It was disruptions in supply, not only of goods but of labor, and disruption of distribution chains, coupled with this huge injection of money into the system, funny money. So we're really kind of suffering the consequences. But to kind of take a couple steps back, I think that in my own chat room and the newsletter, I always I refer to Mr. Powell as our Fed bozo in chief, and I do mean to be disrespectful, because the ideas that he's put out there, or let's say that he has, it's nothing new with him really, but the idea that the Fed should somehow be in control of the economy, or that the creation of money could somehow be tied to real prosperity, is the stupidest illusion. It's a grand hoax. And if you look at what the Fed has done for the standard of living, I'm hard pressed to think of things in our lives that have improved, other than all the toys that we have, some of the amazing technical, the high-tech toys, of which this cell phone would be the best example. And even there, when we kind of assess how cell phones function in our lives, I'm not quite sure that you could make a case that it somehow made things better from what our lives might have been in the 1950s. There's so many things where we're really experiencing a very steep decline in the standard of living, that's masked by all the technical gewgaws and the fabulous equipment and sporting goods that we have. If you want a tennis racket that basically plays your game for you, it's out there. If you want a driver that's guaranteed to give you an extra 40 yards off the tee, that's there too. But I don't see that as much as an improvement in the standard of living, as we have had a decline in many more important things, such as, for one, households need two professional incomes just to get by these days. So the working would-be housewife is really one of the big hits that the standard of living took, because you no longer can have a mother home to raise the children. Neighborhoods have declined. Back in the 50s, you could have such a thing as a poor neighborhood that was really a nice neighborhood, but now they're all crime-infested slums, and even the very best, the most beautiful, God-blessed city in the country, San Francisco, is becoming a dump. The quality of education hasn't improved, certainly, no matter how many trillions of dollars we've thrown at it, and tens of trillions of dollars, and nor has the war on poverty been won. Just things are getting worse in the cities, and We used to have doctors make house calls, but now medicine's such a mess that the doctors themselves are challenged to, see a patient every 11 minutes just so they can churn out a decent living. So in major ways, the standard of living has really been in decline, and most aggravatingly for all of us, we can't reach people at companies. I pay one vendor $4,000 a year for a service, and I can't get anybody on the phone there. They didn't give me a phone number. You can't call a banker anymore. You can't call anybody. All you get in the way of customer service is the ability to talk to somebody in Manila who's text chatting you. So just go into a store, try to find a clerk. If there is a store, they've all been displaced by the big warehouses. So I just don't see. So if you argue that the Fed and its controlling money is somehow making things better, it's not. We're just experiencing, all the Fed has brought us is asset inflation, and the problems that have come with that are sort of masked, as I mentioned, by all the fabulous toys that we have. So anyway, I don't see the Fed as having even remote control of anything right now, and they just sort of make it up as they go along. And for Powell to help sustain that ridiculous idea, I don't think he deserves anybody's respect.
Now, if they were serious about wrestling inflation to the ground, wouldn't they have started hiking interest rates last year instead of waiting so long to even just do it once?
Well, the whole thing about controlling it with interest rates, we're out of control right now. And you can't really raise interest rates and expect things to kind of drift back to normal. That's not going to happen. We've got such a bubble that in the first place, the Fed's battle for most of the last 10 or 15 years has not been to keep inflation at bay. It's to hold off deflation, because we've had an asset inflation and it can only go bust. And we're already there with the housing market. I'm vacationing in the Jersey resort where I grew up. And I know that prices have gone bonkers for all these vacation homes, and in our case, it was a real town where real people live, but no longer. But the homes, when I actually looked at an inventory, a book was talking about the prices. It's like everything on the Longport Beach or Bay right now is it starts at around $2.5–3 million, and it just goes up from there. And you tell me, I guess people sitting on those inflated assets are thinking things have improved for them financially, but how that illusion should be, it's the clearest of them, just because your house is worth $6 million. And I've known people who bought homes in Florida for $4 million within the last year and a half, and one guy sold his for $7 million. So who gained by that? And you could also ask the question, how are we all going to get out of these houses to realize our gains? So nobody's going to escape, really. And the homes in that, let's say, $500,000 to $3 million category, there are no buyers for them. The baby boomers all want to downsize, but there are no buyers for the homes. And I think we talked about this the last time. The homes are going to be traded down, really. They'll be passed down to the kids, so to speak, and the kids aren't going to be able to afford them. And that's going to kill the tax base of every locality right now that's thriving on ratables that are up in the millions of dollars. So that's what's coming. And again, whatever the Fed's doing, it's like, who cares? They're not going to achieve a soft landing. We're already in a recession, generally unacknowledged, but you and I have been talking about it for maybe 2 or 3 months, and there's no way out. So the Fed's tightening at a time when there's going to be a lot of tightening anyway, and interest rates don't really matter. I mean they do somewhat psychologically, but the bust was already here.
Now, Martin Armstrong, who's been a guest on this show, has an opinion about where interest rates are going. What is that opinion, and do you think he's right?
Well, I haven't seen his everything that he wrote about it, but I know someone in my chat room mentioned that he's looking for interest rate. He said we've hit the low and we're going to be seeing interest rates rise for the next 12 years. Now, let me preface what I'm about to say just by mentioning that I have enormous respect for Martin Armstrong. You know, he even did hard time, really, just standing on principle. You know, he wouldn't give up certain information, and I think he took a principled stand, and he went to jail for it. And also, I think as a forecaster, he's terrific. He has a measure of patience that I do not have. I'll look at his things that he's put out in the past, and he's always looking sort of off into the distant horizon. And whereas a lot of my forecasts, I'm always kind of sounding like the sky's going to fall any minute. Don't try to save yourself. We're all screwed. So Martin has a very good track record of looking way out on the basis of his cycles forecasting and saying, the bad stuff is going to hit the fan, but it's just not going to happen tomorrow. So, all right, with all that said, I think that the idea that we've seen a major low in interest rates, it's got to be wrong for either of two reasons, or maybe a combination of both. One is that we're already at a threshold with interest rates where they've killed everything. You know, I've been forecasting initially a high of 3.24% on a 10-year, and I recently raised that to 3.56. I think I'm the only one on the planet, other than a few of my deflationist friends. Doug Bainfield, he keeps pretty close touch with Lacey Hunt and Dave Rosenberg, and there's, let's say, Miss Shedlock. There's some hardcore deflationists who see that we're already at a level with interest rates that it's going to kill everything. And of course, for the economy globally to go dead is certainly not speaking to this idea that nominal interest rates will have to continue to rise. We're already there. They can't continue to rise because there's simply too much borrowing that's been done that's pegged to lower rates. And by that, you know, we've talked many times about the derivatives market, which is a $2+ quadrillion financial edifice. And every time you jack the administered rates up, which have the effect on market rates, by 25 basis points, it tightens the screw on all of the $2+ quadrillion of borrowing that's been done in the derivatives market. So long before nominal interest rates could go any higher, you would absolutely have a collapse, and I think that that's already underway. All right, so if you argue the other way, and I don't think that Martin made this point explicitly, but you could say, yes, interest rates have bottomed for the long term. If you were to add the qualifier that they bottomed in real terms, that could be correct. All right, so it's possible that that's what Martin intended, but I don't know that. But that's the point I would make, that if interest rates were to stay just where they are right now, but you had falling asset values, which has already begun. It's manifest in bids that have fallen away from the housing market. We're in the beginning of a collapse right now, and of course in a bear market that began in January. So if you have the asset inflation that's coming, it's the deflation is inevitable. Then if interest rates simply stay where they are, in real terms, they're going to be increasing dramatically. And that's not a hypothesis. We saw it in 2007 and 8 when people had relatively low mortgages, historically speaking, but they got crushed because their homes were all underwater. Homes were losing value of more than 10% a year. And over the critical years there of the great financial crash, housing on average in this country lost about a third of its value. So I think we're in the second and final stage of that. I've been predicting for 20 years that when the collapse finally came, homes would lose perhaps 80% of their value, and I think it would be even worse for vacation homes, second homes. So that would be my point on interest rates. In nominal terms, we're already high enough to collapse everything, the global economy, and but in real terms, interest rates don't have to go up at all to represent an asphyxiating threat.
We'll have more with Rick Ackerman right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Rick Ackerman. Rick, just a few months ago, we had celebrities telling us, forget about gold. You should be putting all your money into Bitcoin or other cryptocurrencies. There's no way they can lose. Look at, they've gone up from the original 25 cents to over $60,000. Well, they're around 20 grand now. What's your outlook on cryptos?
I have a technical target down around, I think it's 9,000. But I don't think it's going to stop there, really, because we're talking about something that has no value. So 7,000 would certainly be grossly overvalued. And, we've talked about Bitcoin many times. I'm not exactly a fan, and in part because nobody, even the experts, have never answered my really basic question: why should Bitcoin be worth anything? And I'm not intending to diss the idea of the blockchain, and I think that the blockchain is great. It has many uses that we're going to even one right now, the idea of a Web3, a kind of atomized web where you don't have big sleazeball players like Facebook and Google and Twitter dominating the discussion. You'll be able to form groups that are encrypted within a blockchain to have their own rules, their own discussion. So I think the idea of the blockchain is great, but when you apply it to crypto money and ask the question, well, what's it worth? It's worth something, and for the simple reason that that it's able to record a transaction in a secure fashion. However, it doesn't do that a whole lot better than existing technologies, and even as to the transaction itself, none of the cryptos are in the same league with the simple credit card. So the crypto vision never really panned out in the way of crypto becoming useful in small transactions. It's just too expensive, even more so than was initially imagined, because of the energy inputs that are required to create Bitcoin. And so we've seen this collapse, and the couple thousand flavors of branded cryptocurrency, they've all imploded. And I know because I put a few $1,000s into one just to see how it worked. And the deal was that they give you put in $3,000 now. In 600 days, it'll be worth $9,000. Well, not $9,000 actually. It's worth the equivalent of $9,000 in the internal. I won't even call it a crypto. I think I call it a clodal. And they give you clodals, and you keep getting reward points. They don't call it interest rates. You don't get interest on it, but you get your reward points. And that's, nobody even saw that really. Nobody in this venture that was sort of sold like Tupperware at Tupperware parties, but no one even said, well, to be getting interest in reward points, that doesn't seem, can I really trust that? And of course nobody should have. So anyway, Bitcoin should have some value because it's a good way to record transactions in a secure fashion. But how much is that worth? Maybe $2 or $3, $4. Even at that level, it negates a lot of small transactions that might be handled in crypto. But $2 or $3 or $4 is certainly a far cry from the $69,000 high of Bitcoin, over the last, whenever it was. I don't remember when the exact peak was. So there's no bottom for crypto, and the idea that you should be saving crypto, you should prefer it as your strongbox money over gold. That was ridiculous. Anybody who wasn't willing to exchange their crypto for gold coins or whatever should have their head examined.
Rick, the old advice, don't put all of your investments into one basket. I'm hearing from so many people, I put all my life savings into Bitcoin or Dogecoin or whatever, and I've lost everything. Do you have any sympathy for these people?
No, I really don't. Other than that, some of them are my friends,
Yeah.
and but mostly, I'm feeling bad for friends who have gotten stomped by the stock market, and of course, the brokers to a man or a woman are telling them the same thing. They're saying, stick with it. This market's going to come back. They always do. But the brokers who are saying that, and the financial advisors are not supplying some additional caveats. Like if you'd taken their advice back in 1929, you waited until 1955 to get back, to get even. And so we're not going into some routine bear market here and just a simple recession. It's going to be a lot worse. And of course, we're in stage one of people saying, I'm just going to hang in there like my broker told me, because stocks always come back. And my closest friends, I'm saying you should be doing your dumping now. Get out while the getting's good. And of course, you and I have talked about where to go from there. No one has ever gone far wrong buying stuff that everybody hates. And of course, gold and treasuries they qualify in spades if those are your criteria. So, if you've held off on treasuries waiting for them to hit, well, maybe my number 3.56 on the 10-year, this is good, I think a good time to get in on what I call the barbell hedge, a word that originated with my friend Doug Bainfield. But the barbell hedge, essentially gold or bullion versus treasury paper, I think that will see you through the worst of times.
I know people want to survive this wave of inflation that's hit us. The last time we had inflation like this, I think it lasted 10, 12 years. So you have to have a long-term strategy. Is the barbell a good long-term strategy?
Well, let's just take that idea about, everybody's so stoked on inflation. They don't see the deflationary juggernaut bearing down on us. It all has to end in a collapse. You can't have inflation till the end of time. Even a hyperinflation has to essentially snuff itself out. But if you were to take the advice right now, I guess the popular wisdom, then you couldn't do worse than to buy a house. You couldn't do better than buy a house, because homes are appreciating in value still. I think even in places where that represents mental illness, like in San Francisco, it's the homes there. Even dumpy little fixer-uppers are going for $2 million. There, it's definitely Wile E. Coyote who's going off the end of the cliff, and everybody thinks, the prices are still fine, but the fact is there are no transactions. There's very little availability there. Everybody's sort of hunkering down and not selling their home to cash out because they have to live somewhere too. So if you're, if you're really thinking inflation is where we're going, then by all means, go out and buy real estate. But if just my having said that, just sort of puts it in perspective, you've got to be an idiot to go out there and load up on real estate. And of course, we've got a lot of the private equity firms have already loaded up. We've talked about how they were able to get into buy and even to build houses to rent. They didn't care how much they paid for the houses or what they paid to refurbish them for rentals or as rentals. And of course, they're all going to get, you look at it and you think what's coming is almost big enough to take BlackRock down. BlackRock is one of the big players in spec housing, but they paid the top. And even they didn't think about the key with rentals is you're ultimately dependent on the quality of your tenants. So the economy may look great from the standpoint of inflating assets, but from the standpoint of tenants who need jobs to pay the rent, this economy is already in, if not a depression, it's certainly in deep recession. So here, the big private equity players that have gone into real estate have done so, creating or renting homes to people who are manifestly unable to afford homes of their own. So in that respect, they're not a great bet. So that's coming too, and there's just no, there's no supporting that, and it's certainly, the Fed is certainly not going to figure its way out of that one.
Now, for the people who built homes, they've all decided when it comes to high rises, it's going to be a luxury high rise because you make the most money on that. But really, the demand is for low-end real estate. People do want to own something and have some equity. They didn't build that.
Right, they didn't, because that's, you got to think, well, where's the money? And the money was not in building low-income or low-priced homes. It's the same thing with cars. You want a fully loaded SUV to make any money, and nobody was really making any money selling Leafs, the little dinky roller skate hybrids. So the makers all want to, they all want to sell 6,000-pound SUVs.
Well, as the friend of the show, Wolf Richter, pointed out, pickup trucks now go for $80,000, $100,000, and he says they're cheaper to make than a car that sells for $25,000. The suspension on the back of the truck is leaf springs. It's not computer controlled. And half the truck, if it's a pickup, more than half, is empty space. But, they've tarted up the interior of the truck and made it actually very sloppy in its handling to give it a car-like ride, and made it probably unusable as a real truck.
Yeah, very true. I mean, the prices of vehicles in general are insane right now. And, both of my sons own trucks, and one of them, I think it's got over 400,000 miles on it. But it's worth more than it was when it had half that mileage.
Rick, anything else we should be keeping a close eye on right now?
Well, we've covered a lot of territory today. I think it was certainly an enjoyable conversation, Jim. I can't think of too much else. Just one observation: the bear rallies in this bear market haven't been that impressive. It's like the forces of distribution start when the S&Ps are up just 100 points or so. So we're going to get some humdinger short squeeze rallies. They'll be big enough that I'll be ostensibly asking, are we actually going to go to new highs? But so far, you have to be pretty impressed with how feeble I guess impressed is the wrong word, but you have to notice how feeble the bear rallies have been so far. The low that we had a month ago or so in the S&Ps was the culmination of a big ABCD bearish pattern that began on January 4th. So we've definitely done phase one of the bear market, but there hasn't been anything like capitulation yet. Not even. We're so distant from that, with the brokers saying just sit tight, everything will be all right. But worse yet, the customers actually believe that. So we've seen nothing like a capitulation. But I think when it's all over, the Dow is going to be well below 10 grand. And I do have a chart out on my homepage that correlates the market and this big bear rally that we're going to have at some point with the market in copper. So anybody who wants to see that can go to rickackerman.com. It's there on public display.
Rick, thank you so much for chatting with us.
Thank you for inviting me on, Jim. It really was a pleasure.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website, rickackerman.com. If you have any questions for Rick, and we actually do have a question for Rick.
Okay. This will be the first question I've had in all the years I've talked with you, I think. This is exciting.
What does Rick see in the chart for Treasury bonds, TLT, as a proxy for bonds? Is this overdone or more downside to come? Any targets? Thanks.
Well, for most of this year, you and I have talked about a target at 108 on TLT, and it was coming down, down, down. The interest rate that it yielded on the 20-plus year bonds, long-term, was not quite congruent with the 3.56 target that I'm using on, but very close All right. So it did, we've had a turn from exactly 108 point, whatever it was, 0.24 or 0.74, and, a little bit of rally. It then dipped below that number slightly, and now, we're sort of in a launch today. You know, you can look at it and think, well, maybe this is it. Maybe it's finally, lifting off. And again, I like to be there. I think, I think I may be the only, one of very few people who is, bullish on bonds. But the actual target, let me give it to you here. It was 108.74. And on a weekly chart, we're just starting to get a little bit of altitude, currently trading 113.89 or so. So this is, I would say, incipient. It's an indication of a possible major turn here. It's really too early to say this is it. And I think we have to get above, 119 and change, maybe about 119.50 or so, before I start thinking, that interest rates really have, seen their peak. The actual number is 119.75. So we need, about another 4-point rally from here on TLT, to take us out of the danger zone.
Thanks again, Rick. Again, you can ask questions of Rick or any of our other guests if you send them to info@HowStreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.